Hi, this is Gary Miller from Trusted Financial Advisors, and I want to talk to you about taking required minimum distributions in 2009. The question is, should you? Because this year you don't have to. Now, as you probably know, if you've reached age 70.5, the government normally requires you to begin taking a regularly scheduled distribution each year from your IRA. Legislation last year, due to the financial emergency, suspended this requirement for the year 2009 only, and so far there's been no extension of this. So what this means is that you don't have to take the money in 2009 if you don't need it. Now, if you've already been taking distributions, you can stop. And of course, you can always take distributions at any time. In fact, the IRS would love it if you did that because they get to tax you on that money. So if you need some money to supplement your other sources of income, by all means take it from your IRA if there are no other sources of savings. But if you don't have to take the money out, realize that you need to do some thinking about the wisdom of withdrawing money or not. Now, if you were scheduled to begin taking your first required minimum distribution in 2009, relax. You're not under any deadline. You don't have a gun to your head. You don't have to begin taking that distribution until 2010. However, be aware that you will use the value of all of your IRAs at year-end 2009 and divide it by your attained age in 2010, which will be age 71. So you go to the table and you use the factor for age 71, and that will be the amount that you'll need to withdraw. Now, all of that being said, you may want to go ahead and take some money out of your IRA this year anyway, and you may have already anticipated why I'm suggesting you consider this possibility, and that is the possibility of rising taxes in future years. For one thing, we already know that the Obama administration is proposing the end to the phase-out of itemized deductions. What am I talking about? In 1991, a sneaky tax increase was put into place as a political compromise. And what that said was if you earned more than a certain amount of adjusted gross income, your itemized deductions, such as your property tax and the interest on your mortgage, would start to be reduced. You'd actually start to lose some of those deductions. Well, this sneaky tax was supposed to itself be phased out. In fact, it was phased out a little bit for 2008 and 2009. However, the Obama administration wants to end that and bring the sneaky tax back in the form of a penalty for being too wealthy. You lose some itemized deductions. Further, there has already been some trial balloons floated, at least I'm detecting it, suggesting that they may want to raise the income tax rate on income below $250,000. Now, if you remember, in 2008, the president was promising that they would not consider raising taxes on people who earned less than $250,000. There's some little bit of backpedaling on that I'm detecting. So again, we don't know for sure what's coming, but the issue is this. It's possible that you're going to pay higher taxes in future years. In fact, I'll be so bold as to predict that we are today in 2009 seeing the last of the Bush era relatively low tax rates probably in our lifetimes, and the taxes will be going up. Therefore, you might want to consider taking some money out of your IRA even if you don't have to. Now, everybody's situation is different. If you want to discuss the particulars of your situation, please contact me. You can email me at gary@trustedfinancial.com or call me at 949-249-2057. I hope this was helpful. Thanks.